Okay, let's get this thing cooking here. Let's just see if I can break this up a little bit. All right, there we go. All right, well, okay, I just said that I was a King of Mortgage guy, so we're going to move on. Here's what we're going to cover today. How much money is needed? Sources of home buying funds, and could they be from your savings, the 401k, gifts, the lender? What do you mean, the lender? Sell something? What do you mean? So, okay, we're going to talk about that. And then loans. And one of the other things that I didn't even put in here is a seller is a good resource for getting some of the money that you might need for the closing costs. So anyway, let's move on to this, and I'll try to explain each of these. I may even go off of the slides to show what I think a cost would be. So, all right, so you have plenty of money saved. So this is one of those rare individuals that even though this is on how to get out to buy a house with the least amount of money, there are some people that have saved a lot of money, and they just are under the impression that they have to use all of it to buy a house. And so this is based on the people that have 20% down. Now, if you have 20% down, you generally are going to be able to get a mortgage, assuming that you have income. The 20% down is the most favorable for an investor because that's a pretty good stake in the game. Very few people would leave a property or let a property go down that had a lot of equity in it. It just doesn't happen very often, and that's a risk factor. So when you have a high stake in the game or a high investment in a property, you would do everything possible to keep from having that property be foreclosed on. That's why the down payment is such an important thing. But it's not it's not required. In other words, you can get pretty good terms on a mortgage even if you don't have 20% down. And the way it works is increments of 5%. So I didn't put it on this slide, but you can put 15% down, you can put 10% down, you get 5% down. When you shift in to different loan products, you can put 3.5% down, or you can even put 3% down. And there are some loans out there where you don't have to put anything down. Now, on any of the loan products, in the current state of affairs we are right now in 2017, there's going to be closing costs. So there are some costs that you have to pay. There is some money that has to come out of pocket. But if you have money saved, you at least want to look at what the options are so that you can keep some of the money that you have, that you've saved, in reserves. Always a good idea to have reserves. I don't think anybody would argue with that. But if you've saved the money for 20% down, a good argument could be made to using that towards the house. A lot of positive things can happen. Okay. Now, you have money in your IRA or 401k, so you've been contributing to a savings plan through work or through your IRA, and you can indeed use the funds from your 401k without a penalty. Now, in most cases, if you take money out of a 401k or an IRA, there's a penalty attached, plus, and it can be a substantial penalty. I'm not sure exactly what the number is, but I want to say at least 10%, and that could be just the start. You do have to contact the administrator of the 401k in advance. You have to generally, at least for the 401k, I know you ask for a hardship request that you're going to use the money for the down payment on a house. I think one of the requirements is also that you be a first-time home buyer. Now, there are some criteria in some cases where I believe that you only have to have not been in a house for the last 3 years, but that may be wrong. You have to check with your administrator, and each administrator could have their own rules about that. Usually it takes about a week to get the money, so it's not a big process. It's pretty much if you have the money, if it's vested in your name and you have access to it, your company allows that, then you can get that pretty soon. Now, I always encourage you to check well in advance because you don't want that to slow something up when we're trying to close on time and stuff. So be sure and check that information early. Check with your administrator right away. You can get gifts from family or close friends. Now, a lot of people use this, and the way the rules are written for FHA and conventional loans, and VA for that matter too, is a blood relative can gift you funds for the down payment or even the closing cost. And that includes parents, uncles, aunts, brothers, sisters, grandparents, and any other relations that I might not have listed there. If they're blood relatives, they're capable. When I say capable, it's okay for the FHA or conventional people to do that. Now, I know that this is true with the FHA, but longtime friends with proof of a long-term relationship are also allowed to gift you funds. And I've seen this happen once or twice over my tenure in the mortgage industry. And it doesn't take a lot of proof, just takes some clarity that there has been a long-term relationship there. And then finally, the other one that I've seen is couples that are engaged to be married can gift each other the funds. This is usually a situation where one of the borrowers or one of the couples is not going to be on the loan. So the funds could be gifted, or even if they're both going to be on the loan, the money can be used and the access be there. Now, I always like to mention this part of it. The donor of a gift must prove that they A, have the money to give, and then this is the tough one, the money must be tracked from the donor's account to the account of the recipient, or the borrower in this case. And the truth is, some donors don't like this part. They don't like exposing their account. I mean, it's one thing, they're probably not that thrilled to give you the money to start with, and the fact that they have to kind of open their coat and show what their assets are to people that they don't know, or for that matter don't trust, it just rubs them the wrong way. And I've had some people just flat out not give the gift because they didn't want to do that. They didn't think that they had to. And in almost every case, it's a requirement. So that is something that you want to go over with anybody that says that they would be willing to do that, and just explain or have them call me. I actually did a specific video presentation, so it was really for the donors so that they would understand what they're getting into. So I think that's an important thing to say. So I put a little picture of a statement down there. That's what that is right there. Okay. So funds from the lender. Now this is an interesting one. You won't hear this from a lot of different people, but the lender can help you pay closing costs by charging a higher rate and using the additional yield that comes from the higher rate to pay for your closing cost. Now, I know that a lot of people don't like to do this, and I don't think it's a great idea, but it is an idea. And so here's an example. If you have let's say you qualify, and this is particularly on FHA, I don't think it works as well because the yields aren't as big on conventional loans. But 4 1/4 rate, let's just say, is the rate that you get on an FHA loan. And again, that's going to be, it could be totally out of whack by when you're watching this, but today 4 1/4 is not an unusual rate for an FHA loan. And let's say that you're okay with accepting a 4.5% rate as long as the lender contributed 1% to your closing costs. Now, on a $200,000 loan, that would be $2,000 that quarter is bringing that the lender can contribute to your closing costs. Now, $2,000 goes a long way when you're doing closing costs. You could do the same thing, assuming that days are like they are today. Instead of doing a 4.5%, you do 4.75. So you're actually a half above what your normal rate is, but you are getting credited with, on a $200,000 loan, up to $4,000 to help with your closing costs. A lot of times, $4,000 would cover a lot of the closing costs. Now, I've got to stop here and say that the quarter and the 1%, these are estimates. It's not going to be exact. Sometimes it could be a little more, sometimes it could be a little less, sometimes it may be dramatically less. These are examples of what it would happen. And so your question should be, how much does that 1/4 or 1/2% cost me? in the loan. And I'll give you an example. The difference between 4.25 and 4.5 might be $35 difference in your monthly payment. And if it's from 4.25 to 4.5, that might be $70 more in your mortgage payment. So what you're basically doing is you're trading upfront money, the $4,000 you're going to get for your closing costs, for you're going to pay it back in the fact that you're paying a higher payment. And for some people that works. I mean, for some people that makes sense. And the purpose of this particular presentation is just to let you know what's available out there. And this is one that pretty much most lenders would acknowledge that they're able to do. Now, some might not. Maybe some of the banks or the institutional groups couldn't do this, but in the world I live in, we could. So just so you know that. Okay, this is common sense. Sell something you own to raise money for a down payment. It's a great way to fund your down payment. Now, I got to tell you, there's a little bit of criteria about this. Be sure that you can provide a paper trail for the whatever it is you sell. Generally, they'll want, a lot of people sell things on Craigslist. Good way to sell things. So what they'd want to do is they'd want to see a copy of your ad that you had on Craigslist. Now, if you sold it to a friend, we'd want you to have a bill of sale and that receipt showing that you received X number of dollars for the sale and the transfer of this property. So that's what the bill of sale does. And then finally, what an underwriter is going to ask you about is an underwriter is going to ask you to compare other items that are being sold that are similar to the one you sold, and they're being sold for a price that's consistent with what you received from that. And I'll give you an example. I had a guy I was doing a loan for, and he was, I didn't ask him to do this, but he was selling, and he was a gun and ammunition sales guy. He was very involved in selling guns and ammunition. And so he had to kind of backtrack and show, but you can see in the picture I've got for this particular slide, I've got cars, I've got rings, I've got guitars, I've got ski-doos, and then again there's guns. So those are things that people own that are of value, that are pretty easy to sell if they want to do that. So hopefully that's helpful for you, and it's kind of an interesting way. A lot of times you don't think about selling your stuff. So it's a good idea. Here's one that's crazy. Can you get a loan for the down payment? Well, the answer is kind of yes or maybe not. Depends. Underwriters are very sensitive about borrowing the funds for a down payment. And I can tell you for sure you cannot get cash from an open credit card or an open-ended credit card or anything that would be unsecured. What they're looking for is you can get an installment debt, preferably for an owned asset. And here's an example that I've seen work. So you own a car. And the one that we did, the car wasn't owned completely outright, but the balance of the car was pretty low. The value of the car was more than what they owed on it, which is not always the case, and a lot of times their cars are upside down. But in this particular case, they had a small balance on the car. They were able to refinance the car and get some cash that would allow them to use that money for a down payment. Plus, it has to fit within the debt ratio. So this new loan would be put on the credit, even though they had a car loan. They got a new loan for the car. That first one was paid off, and then it was a higher balance, but they got the difference in cash. So this was a pretty darn good way to get some cash if you had a situation like that, and you just never know what people have. I think we're going to talk about one more. The standard way to get a little bit of extra money is to ask the seller for closing cost help. Now, in most markets, in the majority of the time that I've been in the mortgage industry, which is just a little over 20 years, most of the time this works. We're in kind of one of those unusual times where in many cases it is a seller's market. And a seller's market means that there's more buyers out there in certain price ranges than there are sellers. So when a property goes on the market for $200,000 or less, it seems like there just are a lot of buyers out there. when a buyer is facing multiple offers, when they make an offer and they're asking for closing costs, they're basically discounting the property. And what ends up happening is that an easy way to get that property is to not discount it, not ask for the closing cost. So in a situation like that, that's what the premise of going over some of the different ways you could do this. And the key thing is, if you wanted me to give you a projection of what it costs to buy a loan, you have to think about it a couple different ways. One, you got a down payment, so a minimum down payment's about 3%, and then you have to figure about $3,000 or $4,000 to pay for closing costs from the title company, from the lender, and of course your tax and insurance escrows. So I'm reluctant to give out just a standard answer, but I'm going to say you need to have around $10,000 or access to $10,000 for you to be buying a $175,000 to $200,000 property. And again, anything more specific than that, I encourage you to call me. My number is I'm gonna have my number on here. Well, as a matter of fact, I'll come back to calling me back. But anyway, on this one, this is what I covered here. And I like to round it up, tell you what we covered, and then just kind of follow it back up, because I don't want you to sit on these things if you don't have any interest in the items that we're going to cover. So how much money is needed, source of home buying funds, savings, 401k, gifts, lender, sell something, and loans. And so the final part of this is where you can call me. Here's my smiling face, and got the homebuyerwebby.com. This is where this video, this webinar will be housed. You can call me at my office, 281-348-9899, or you can go on the Kingwood Mortgage Guys site. That's kingwoodmortgageguys.com. And again, there will be a link to this site and this presentation. But the most important thing is to call me. I've got my email on there and, of course, the phone. So love to hear from you. I appreciate you showing up tonight, and I'll look forward to talking to you soon. This is Mike Durr, the Kingwood Mortgage Guy. I'm signing off tonight.